Hi, everyone. I'm Michelle Yu, and welcome to the ETF show here at the New York Stock Exchange. Joining me now, a very special guest, Head of Equity Strategy at WisdomTree, Jeff Weniger. So great to have you. And in light of ongoing rotation between value and growth, what should investors consider when positioning their portfolio?
Yeah, well, I'd say that if you're thinking about right here in June of 25, value and growth are being driven 99.9% based on inflation prognostications. I mean, that's pretty obvious when you're looking at the tape in the first half. And, when the market was, I think we could say tanking. Market was absolutely tanking there in February, March, and April. It was on a stagflationary thesis. And if you were basically on that, value was holding up better in that pecking order of downside. Losing less on the downside, I guess you could say. And then as that's alleviated since then, and we came ripping back, what's been outperforming? It's been growth on stagflationary fears receding.
What should investors look out for when it comes to equity markets as macroeconomic data, like the latest jobs report, is shaping, what's happening around the Fed policy and inflation?
Well, the data in the last week or so, jobs report, but then there's also things like retail sales. That's all over the place. So you have to it's going to be a funky summer because we're still kind of doing a lot of that, making up for things that were front in the first and second quarters. And then in the third quarter, will we have other vagaries in the system? For example, retail sales up big in March and then kind of like a non-existent report in April and then down big in May. Well, it's because you went out and bought your items then. Now you've already bought it. So there's a lot of these things where it's like, hold on, slow down, be careful with the data flow. You almost need to use some moving averages to try to smooth some of these things out. Each passing year is going to be different from other years. 2025 is just a funky one.
So with the uncertainty of timing and trajectory rate cuts, how should investors balance short-term caution with long-term growth objectives?
Well, okay, short-term caution. Okay, think about it from this perspective. If you panicked out in, let's say, the first week of April, that's now probably going to take you years to make back, assuming we persist with bull trends through time. And we were down 19%. If you sold the low when the VIX was north of 60, you just created basically a cardinal sin of markets. So try to make sure you have that long-term perspective. When you're seeing volatility spike, that should be something where it's telling you to go long, go buy. We had the VIX at 40, and I'm going to sell 50, I'm going to sell 60. And these are buy signals. Those happened back there a couple months ago. Now you're kind of stuck because the S&P is around 6,000, and maybe you sold everything. You're saying, now what am I going to do? And you're chasing markets around.
So how does the QGRW focus, how does that differ from traditional growth ETFs in today's environment?
Okay, QGRW, well, that's our quality growth mandate. It's NASDAQ-y. It skews, I'd say, relative to other growth mandates. It's more mega cap growth. It's got a ton of the Mag 7. Oh, I don't know what's the definition of Mag 7 anymore because I think picking Tesla out, we're putting is Broadcom now Mag 8? Who knows? But those end up populating in there because you're screening for return on equity and return on assets and, and earnings growth. And surprise, you get a lot of tech and communication services in there. So in like a style box, is way upper right-hand corner. It has had a sharp recovery off that V-shaped bottom. So if you're on growth trends, you're on momentum, if you're on what has worked in recent years persisting into 25 and 26, that would say something like QGRW.
How do investors view quality growth exposure in today's environment of inflation and elevated rates?
Well, I don't know that inflation is such an issue anymore. It's funny because you see the prices of things that you're purchasing are high. But now we have to consider them on a year-over-year basis. And right now, year-over-year inflation is 2.4. We at WisdomTree would say it's lower than that because I think everybody in this whole room knows inflation is being overstated on the owner's equivalent rent and rent side. That's painfully obvious. So now you're starting to say, okay, it's 2.4 on CPI. Is real life CPI something south of 2? Still problematic because you got to pay an arm and a leg for dairy and cars or what have you. But that's the new lay of the land here. We have deflation being exported to us by the Chinese, for example. You have money supply growth is tepid in the Eurozone, in the US, in Japan, and on it goes. So you have that disinflationary backdrop. And if you think about it, the only time growth didn't really like the system was when we were spiking in 22 banking. And then also that little 6-week comeuppance here in the beginning of this year, which was all inflation concerns. So the extent that that all starts to become on the wane, we get this sweet spot, like I just recently wrote a blog called the Goldilocks inflation. Let's hope I'm right. You use the term Goldilocks, you got to be careful. That is a setup for these types of mandates. This is a 2023, 2024 type setup, benign inflation, growth on.
All right. Well, Jeff, thank you so much for the insight and joining us here at the New York Stock Exchange.
My pleasure.
All right. And I'm Michelle Yu. That will do it for Asset TV. See you next time.